From tax refunds to bucket list adventures, smart money management. Join the bucket list accountant himself, David Patterson, as he delves into the common frustrations people have with tax refunds and the importance of focusing on effective financial management. David discusses strategies for employees and business owners, emphasising the significance of using funds wisely throughout the year rather than depending on lump sum refunds. He highlights the need to align tax planning with personal and business goals to support one's financial aspirations and bucket lists. Don't miss these insights on making smarter financial choices to achieve your dreams. I'm your co-host, Anthony Pearl. Let's get into making your bucket list happen. Hello, David, and welcome to another episode. And I guess the big thing that we've had some feedback on, and I think it always happens certain times of year where you start talking about tax, and it's such a negative subject for the majority of people, right? It's not something that they generally want to talk about. So how do you correlate tax and a bucket list?
Well, it's a very interesting question, Anthony. And I must admit, I had a client in just 2 days ago, and they were moaning the tax refund that they were getting back on their tax return wasn't very large, and they were complaining is the right word, about how they weren't getting a big refund, and a lot of other people that they know were getting big refunds, and it wasn't fair. And it's just interesting, and it highlighted people's approach and thought of tax rather than their take-home pay and what they've got left at the end of the day. And I see too many people, their focus is on tax and saving tax or getting a bigger tax refund at the end of the year, rather than thinking about what money that they've got and how they can use the money that they've got to sort of help them with their bucket list ideas.
I mean, because the principle of a tax refund is that you've paid more in tax than you should have done. So which kind of talks to one of a couple of things, doesn't it? You're the accountant. It talks more to either overcompensating, so you haven't done as well as you thought you were going to do, and certainly as the tax man thought you were going to do, or it's just bad management.
Yeah, it's a combination of the two. And I think one of the things I explained to these people the other day was that there's really only two ways that we can increase their refund. One of them is to, and these were salary, wage earners. So one option is to have their employer take more money out of their wage every week, in which case they've got less money week to week to live on. The other option is to spend more on tax deductible items for their business. But again, and I was giving them the example, if you spend $100 on a tax deductible item, on average, you'll save $34 in tax, but you've had to spend $100 to save $34 in tax. Now, if you don't have to spend that money, you'll have to pay an extra $34 in tax, but you'll have an extra $66 in your bank account as a net result. So you're better off if you don't have to spend the money to get the tax deduction than the other way around. And sometimes it takes people a while to get an understanding of that if you don't have to spend the money, don't.
Yeah, it is an interesting idea, isn't it? Because it's people love the idea of that surprise. It's this bonus. Oh, I've got money back. But you're right. I mean, isn't it better to have the money consistently available to you throughout the year than getting a bonus surprise, which shouldn't be getting a bonus surprise, really?
No, that's exactly right. I mean, at the end of the day, if you don't have to spend money on items to help you with your work, then your employer should be taking the spot on right amount of tax out of your wage every week. You get to the end of the year, you do your tax return, $200 or $300, $300 or $400 as a refund. That should be what it is. A lot of people will get extra taken out during the year week to week because they feel that they're not going to miss it week to week. And they like the idea of it's almost like a forced savings. So they like the idea of getting $5,000 or $6,000 back at the end of the year rather than having it week to week because they figure that they'll just spend it on, anything. Whereas at least this way they get a large injection in. And I've got a few clients who actually do this, and then they use their refund money that they get at the end of the year to take a holiday, pays for their holiday overseas.
That's a really interesting idea because, we talk about bucket lists and as we have done in many of the episodes. And surely there is a better way and a better place to be putting that money and getting the same result, maybe even a better result, because surely if you're putting away, $100 a week, for example, surely that's better in some kind of even a short-term savings account.
Absolutely. And I think in a lot of discussions that I have with people, it comes down, as much as anything, it comes down to self-discipline. So yes, if you set up an additional savings account and you, rather than having your employer withhold tax, you put that money into a savings account, you'll earn interest throughout the year, whereas the tax office aren't going to pay you interest by giving them money. Or you can put it off your mortgage as an offset, which again will save interest on your mortgage. But what the people that are actually getting money taken out of their wage and sent to the tax office, one of the main reasons they're doing it is that they don't have enough self-discipline to keep that money in the bank account. So they'll get partway through the year, and if they see $2,000 or $3,000 sitting in their bank account, that the incentive there to drag it out is too great, and they end up spending it. So the extra money to the tax office becomes a forced saving if you haven't got that discipline to put money into a bank account and leave it aside.
I mean, how do you deal with people that haven't got that discipline? Can you sit with them and actually help them set up another bank account and set up the automatic transfer of funds and make it so that it's something that they can't just on a whim pull the money out, that you need a little bit of notice to maybe pull it out?
Yeah, absolutely. And we've actually done that with a few people, in that you can set up a bank account and you can make sure that bank account doesn't appear in your, that you can't have access to it online, and that you sometimes physically have to go into the branch to withdraw money out of the account. That way it's kind of hidden. So it's kind of like sending money to the tax office and you can't see it in your day-to-day listing of bank accounts. And that way you have to physically go into a branch to withdraw the money or transfer the money from that account to another account. That's the best option that we've come across for people that don't have the discipline to leave it in there.
This podcast is brought to you by bucketlistaccounting.com.au. Speak to David Patterson and his team if you want to take better control of your life and business, helping small business owners like you be successful designing the life of your dreams. Go to bucketlistaccounting.com.au or check out the show notes for more information. Now back to the program. I want to go back to the interesting idea that people are going and saying, well, the money that they're going to get back on tax is paying for a holiday. Is that an effective way of, whether you're doing it, siphoning it into your own bank account, or whether you're waiting for it to come back from the tax man? How does that correlate to a bucket list? Is that an effective way of doing it? Is looking at it as almost as a bonus?
It's not so much as I don't think they're looking at it as a bonus, but they know, and I'll keep using the holiday as an example, that they know that they want to have a holiday at the end of the year, and that they know that this method is the best way for them to come up with $5,000 to be able to pay for airfares and accommodation at the end of the year, rather than getting to the end of the year and trying to work out how it is that they're going to pay for their flights and accommodation. So either way, whether it's giving the money to the tax office, prepaying almost, or putting it into their own bank account, it's a great system to use to save up for one of your bucket list items.
I think it still goes back to, as well, though, if you're employed, and I think we should come to a moment to business owners, but if you're employed, surely they shouldn't be overpaying in tax anyway. Why would an employer be making that happen?
So it becomes the request to the employee to the employer. So that you have to, as an employer, you have to go to the employer and say, could you please take out an extra $100 a fortnight out of my pay in tax? And then if an employee requests that, then the employer virtually has to do it.
Is there any disadvantage to the employer for receiving that request?
No, none at all.
So let's turn our attention to people that are running their own business, where the difference with an employee, of course, is that you're on X amount of dollars a year. And so presumably you can work out the tax fairly accurately. But the problem, of course, when you're a business owner, you're susceptible to all sorts of things that happen in business, rising costs, changes in the amount of clients that you have or the products and services that you're able to sell. All of those variables will impact you. So how do you deal with tax, but in a way that you still want to maintain, because this is the theme that we still want to maintain some kind of a bucket list.
Yeah.
When you've got that kind of variable, how do you combat that?
I think from a business owner's perspective, there's probably two main elements to this. One is down the tax angle, and a lot of business clients will come in, and one of the main statements that they make is that I don't want to pay any tax. So, but ultimately, that theoretically, if you're not paying any tax, you're not making any money. So for a business to be making money, ultimately they have to be paying tax. It's our job as accountants to help to keep that tax figure as low as possible. But it's a similar concept to the employee in that business owners will quite often ask, if I spend $15,000 buying this piece of equipment, will that bring my tax down? The short answer is yes, but the longer answer is, will that piece of equipment either make you more money or improve how you do what it is you do so that your efficiencies improve so that you make more profit? If the answer to either of those two questions is no, then you shouldn't be buying the piece of equipment. A business owner shouldn't be purchasing something just for the sake of getting a tax deduction and keeping their tax low. They should be making purchases based on improving the efficiency or improving the turnover and the profitability of their business. And so that indirectly, that then flows to the ability to isolate money from their business into a different bank account again to save up for the things that they want to do, the things that are on their bucket list.
Tell me though, is there a point where you get towards the end of a financial year and you're looking at how the business is going? And is there a point of saying to them, it's worthwhile making that purchase because we know what's on your bucket list, because you've discussed it beforehand? Now would be the time to make that purchase because there may be some tax advantage to doing that, depending, of course, on the nature of what the purchase is and assuming that it's for the business.
Yep.
Is that something that you get into that proactive area of looking at?
Certainly, and coming towards the end of the financial year is the big time for this, in that if there's a piece of equipment or a purchase that they're looking to make, and it may be something that they make in the next 2 or 3 months, say June, July, August, then in that scenario, what you might say is to bring that cost forward so that it comes into the current financial year so that you get the tax saving now rather than next year, which then gives you a bit extra money in the account now rather than having to wait for 12 months. But again, it's only something that you would recommend and suggest if it was going to be a cost that they were going to incur anyway. And in that scenario, you would definitely bring it forward.
I know you do a lot of work with the business owners and people about their values and forming all these bucket lists and things that we've spoken about previously. And one of the things that we probably only just touched on a little bit is the idea of charities and not-for-profits and making a donation. So if that's something that is, very dear to you, wanting to be able to do that, is that also something that comes particularly because of that tax deductibility? Is that a big factor at the end of the year? And is it better to be looking at it at the end of the year? Or is that better to be looking at it on an ongoing basis?
I think the whole approach to that philanthropic element of your business and your person is probably more suited to across the entire year. So to be continually looking at it as you go along rather than wait until the end of the year, because it's more, I think there's becomes more benefit to you personally and to the charities that you're getting involved with. If you're a regular contributor throughout the year, you end up with the same result. And probably from a cash flow perspective, it's better too, because you're spacing it out over 12 months rather than chucking a whole heap of money in right at the end of the year. It's something that you would look at the end of the year, see how the business has performed, and talk to the business owner and say, hey, you've done really well this year. There's an opportunity to be, maybe put a little bit more money into one of the causes that are meaningful to them.
I mean, you often see a lot of charities having these end of financial year appeals. How realistic is it that with a lot of the businesses that you deal with and small business owners, that they get to the end of the year and they say, look in the account and go, well, look, if you made X amount of donation, it actually probably wouldn't cost you anything because the tax deduction is, makes that worthwhile and brings you into a different bracket. Does that actually happen that often?
No, it doesn't happen. It doesn't happen a lot. It's for only those people that are sort of around a tax bracket, and it may be that a certain level of donation will drop them from one tax bracket down to the next, which is certainly advantageous. But the majority of people are probably falling in the middle of a tax bracket. So a larger end of year donation probably doesn't have a huge impact. But I guess it's probably just a really good marketing ploy from the charities because, I mean, you see everyone doing it. Any stationery place, Officeworks, that everyone advertises end of financial year, car yards, end of financial year stuff as a way for a business to get an extra tax deduction. So it's a great marketing ploy because people are thinking about how they can save tax. But there's not very often where they can spend enough to be sort of no worse off from a tax, for the amount they spend by the amount of tax that they save.
I often wonder with some of those end of financial year sales that they're more driven by a notion that comes out of larger businesses that give their departments or their staff budgets to spend, and the fear often being that, look, we had $10,000 to spend. We've only spent $9,500. If we don't spend the extra $500, then next year they're probably going to give us a budget of $9,000 rather than the 10 because they'll want us to save a little bit. So we should go out and spend the extra $500. Officeworks, here we come. I don't know how real that is anymore, but that's perhaps where it comes from. Possibly.
And it's also, traditionally there's been the push too, from accountants during a tax planning phase, say April, May and June, where businesses are looking at ways to bring their tax down. So it plays into that tax planning session very, very well. But again, ultimately for me, it's all about purpose. So if charitable donations are important to you, absolutely, let's do it. But it's got to have a bigger reason other than just a tax saving. For me,
I guess just to sum things up in this discussion, I mean, correlating tax and your bucket list, is it a smart thing to be doing?
I don't think so. I think the tax discussion should be a secondary discussion to be had with your accountant. And I'm not trying to underplay tax. It's certainly important for businesses to try and minimise their tax as much as possible, legally, of course. But I think the bigger discussion is about, people's bucket lists and what they want to do and making sure that their business is being driven towards greater success and towards the ability to be able to do the things that are important to them. And I think if business owners look back at the end of their journey and if they've been able to do the things that are important to them, they're not going to remember how much tax they saved in 2024 when they're sitting back in 2036 reflecting on their business career.
The Bucketlist Accountant podcast is brought to you by David Patterson and his team at Bucketlist Accountant. Go and visit their website for more information, details of course in the show notes. I'm Anthony Pearl, your host from Podcast Done For You. We look forward to having your company in the next episode.